Welcome everyone. My name is Humberto Ijar. I'll be very happy to guide you through these slides on the presentation today on cash flow command and planning for profitability. Let's go. Session objectives for today. We'll map them out for now, and then we'll go addressing them each one line by line of sorts as we go through these slides. Become familiar with the concept of cash flow. That's going to be the primary one. Define both profit and loss statements and a cash flow statement. We're going to go over the differences between the two. Understand the difference between positive cash flow and profitability. Very important. Often interchanged and not necessarily the same thing. All right, important to know the difference between the two. Define the importance of cash as it pertains to the livelihood of the business. We'll go over that. Use a cash flow statement to evaluate the health of the business, and then improve strategic decision making. Okay, by the end, we'll combine all of these concepts, and hopefully we'll get you to a place where we can utilize the concepts and the statements to improve our decision making in a very strategic way. Here we go. We've got a little bit of this, right? For entrepreneurs, mastering and understanding analysis and management of finances is crucial, absolutely crucial for the sustainability and the growth of the business. This journey does begin with a deep dive into three fundamental financial statements: balance sheet, income statement, and the cash flow statement. Okay, so getting over a little bit of like that fear, don't like to call it anxiety, that fear of what am I going to do with this? Do I even understand it? What does this mean? What is it telling me? So managing this understandably could be quite stressful, right? Particularly when income is inconsistent, making a challenge to meet regular expenses. It does complicate, our ability to maneuver these things smoothly, right? Also, we see here complicated tax regulations and the fear of penalties only add to the fear of staying compliant and on track. Additionally, we see here unexpected costs of economic downturns and complicate future planning, can complicate future planning even further. So we're going to do everything we can. We're going to control everything we can control for us to conducively make decisions in a very important manner. The purpose of understanding these concepts and in these statements is to allow them to communicate to us what we have in front of us, what we have in the future, and how do we get from point A to point B. These are tools that we can absolutely utilize for our benefit. It's not only information being reported back to us, but it is the mathematical representation of all the possibilities that are ahead of us. If we use them strategically, if we use them intentionally, my goodness, we can be singing in no time by understanding and manipulating, and I do mean manipulating in the sense of controlling and predicting the future. What can we get to from point now to 6 months from now to a year from now, 5 years from now? We can utilize all of that information and put it into practice and manipulate our practices in order to get to your desired outcome. The balance sheet, it's going to show us the assets, liabilities, and the net worth of a company. This is the first one that we'll explore. This is, however, at a given moment in time, right? Every time we pull it, it's like we're taking a little snapshot of the health of the business. It encompasses all of that. What we have, the belongings that we have, called assets, the liabilities, anything that we owe, all the responsibilities that we have within the company, and then ultimately the net worth at that moment of the company. Excellent. Our next financial statement is profit and loss. This one shows us the income and expenses experienced by the company during a given period of time, right? This is also commonly referred as to the income statement. It outlines, again, the company's income and expenses and profits over a period of time. Starts with sales, moves all the way down to net income. Okay, that's what the profit and loss statement shows us. We're going to go to cash flow. This is the third one that we're going to take a look at. This one shows us how cash enters a business and cash leaves a, man, that's hard for me to say today. Cash leaves a business. It exactly what it says it does. It's cash in, cash out. all of the modes of cash coming in. This may be credit, this may be other things, but all of the income or all of the revenue streams or money streams that are coming in, and then all of the ways that it leaves, right? This statement tracks the cash flow in and out of the business, categorized into operating and investing and financing activities. It provides insights into the company's liquidity, which is really, really important, revealing how well it manages its cash to fund the operations, invest in growth, and meet financial obligations. It all comes down to this statement. Let's explore the journey of a dollar. Journey of a dollar. We've got our 3 statements that we spoke about. This is what we're exploring. So, dollar comes into the company. What happens then? What happens then? What is that cycle? What is that journey? How do we map it out? How do we understand it? How do we plan for it? Okay, we're going to look at a few concepts here. Cash on hand. We're going to see this on our cash statement, cash flow statement. We'll see it here. This is the starting point for our dollar. This is the starting cash or initial cash position before entering the operating cycle. It is essential to fund the next step in the cycle. So before we start anything, before we can produce or sell or bring in any income from our business, it's going to be important for us to have a little bit of cash in order to fund the operations of the cycle. We have here expenses and inventory. This aligns with the purchasing stage, where the business uses cash to acquire inventory or raw materials needed for production. That's where the cash in hand comes. We utilize it to purchase the raw materials, start producing either our final good or our final service. We transition then to the delivery of service and goods. Now that we've formed it, now that we've manufactured it, now that we've produced our final good or service, how do we deliver? This represents the production stage and the sales stage, right? Where goods and services, we're going to be transitioned from production into the hands of the customer. Okay? Finally, the cycle goes all the way back to receiving a payment. This is going to match our accounts receivables collection stage, where the business collects cash from sales, completing the cycle and replenishing the cash on hand. Therefore, starting with cash, goes to expenses, right? We purchase material, we produce the material, we produce anything that has to do with our product, final good, and or service, receive payments. Those payments are going to go back to the cash on hand to replenish the cash on hand that we started with. Thus, the journey of the dollar, right? Thus, the full cycle of the operations and cash coming in and out. Cash on hand. This is the first of the terms on the cycle, right? Cash on hand here refers to the available cash that a business possesses at the beginning of the operating cycle. This cash is vital as it funds the initial phases of the cycle, allowing the business to purchase inventory, pay employees, cover any operational expenses. Having sufficient cash on hand is essential for a smooth operation and ensures the company can meet its short-term obligations without any disruptions, right? Cash on hand may come from various sources, including revenue from previous cycles, financing, or any other capital contributions, okay? Effective cash management at this stage is absolutely crucial. Too little cash can cause delays in purchasing or paying employees, while excess cash that isn't actively invested or actively being acted on may lead to potential future issues as you're counting with that in your operating cycle. All right, crucial to have accounted for cash on hand and enough that you are controlling the maneuvering and the process of this particular aspect of the cycle, right? Crucial. Very, it's a very mindful practice of going in and trying to control it to the point that you know how to predict from one month to the other. Okay, payment to the employees and expenses, essential, right? Essential. Allocating cash to cover these operational expenses, including staff salaries, any other necessities, is going to be absolutely crucial to maintain a motivated workforce Imagine if you can't pay them on time. Imagine if you can't pay your employees on time. Imagine if you can't pay yourself on time. What stresses might that bring? So absolutely vital to count with your cash on hand at the beginning of each month in order to cover these types of expenses, right? Buying inventory, the purchase of anything that you have to acquire to produce, to sell, to manufacture, to engage in the process, absolutely vital for you, for the cash flow to continue, right? Really, really, really important. Timing, quantity of purchases are critical decisions. The impact is huge. Again, it can absolutely disrupt your flow and your cycle. So the timing, the mindfulness of everything that's coming before to where you are now, absolutely vital. Finally, delivering the services. Delivering the services or goods or final products that you're manufacturing marks the point at which the business fulfills its promise to the customer, right? If you're thinking about it, the cycle ends there, but then it begins again. It begins again. Transforming inventory or resources into revenue-generating assets, absolutely vital. Absolutely vital. In a production-focused company, the stage may include manufacturing or assembling products, while in a service-oriented business, this may involve the actual delivery of a service. This phase then becomes critical because it translates quite literally the resources and the labor investments into tangible outputs that the customer is going to value, right? Into tangible outputs and or services that the customer is going to value and then come to you for, give you back some payment. Payment goes back to cash on hand. So the timing, the process, the phase, absolutely critical here. Receive payment, final stage. Payment collection, end of the goal. This is what we're doing it, right? Not this is why we're doing it. This is not why we're doing it, but this is the result of everything that we're doing. It represents the goal, the end goal of the operating cycle, turning receivables into cash. For many, many, many businesses, this step involves collecting payments for customers who purchase on credit, purchase by cash, purchase now by Venmo, which is another type of credit. I mean, there's no overstatement that this phase impacts the cash flow directly, as is the replenishment of the everything that we've spent for the operating cycle, right? It replenishes back the cash on hand. Any delays in this payment collection could be hugely impactful. So strategizing as to how to collect things on time, crucial for your operating cycle. Anything that's delayed there may possibly delay other parts of your operating cycle. All right, here we go. Putting it into practice. So let's go through a little example. Your company's facing cash flow problems due to delays in paying suppliers and receiving customer payments. Very common issue. This is absolutely slowing down the inventory turnover and affecting profitability. You need to quickly identify one area in the operating cycle to improve in order to get cash flowing faster. How do we do this? Let's assess the problem. First thing, right? Assess the problem. Where's the delay? Where is it happening? Why is it happening? Is it because customers are slow to pay, or are suppliers demanding payments too quickly before enough sales are made? What's going on? What is that relationship? Where is the friction? Where is it happening? Let's identify, and then we're going to pick one of these three areas to focus on for improvement. Maybe one, maybe two, maybe three. Maybe all three need attention, but we're gonna see which one needs the most. So we can either negotiate with suppliers, right? That's one of the areas of focus. We can incentivize customers to pay a little faster. Interesting program. We may increase inventory turnover, right? That might solve some of those flow issues. And then the questions here to ask ourselves are, how do these suggested changes, how does this suggested change help the dollar return to the company faster? What's gonna make the dollar come in faster, and how does it do it? And how does it affect that change, right? And then the second question is, what benefits could this have on the cash flow and profitability? So assessing problem initially and then picking the areas of focus lead to the results on the bottom on the two questions that we're asking here. Which one can get us there faster? Which one can get us there more efficiently and with less friction and both customers and potentially providers or suppliers, right? Evaluating the philosophy of the process and where less friction will come could be vital for not only the cash flow, but also the branding that you've worked so hard to acquire, right? The way that you communicate, the way that you interact with your customers, like that might be affected a little bit as well. So think about all of the moving pieces. Think about which one's going to give you the less issue, which one's going to give you the less friction, and also while balancing the quicker turnaround and what's going to get the cash flow coming in faster. Make sense? Okay. Why is this important? So, missed opportunities, right? Cash flow shortages can prevent businesses from investing in growth opportunities, such as hiring staff, expanding product lines, and entering new markets. Absolutely. If we don't capitalize on those opportunities, if we don't have the processes or the conditions ready to capitalize on opportunities, we may miss out on growth, on hiring, because things aren't there. The resources aren't there. And there's something else that we could have done, right? Strained relationships happens all too often. Late payments, suppliers are not going to like it. They're not going to like it. I mean, they're going to strain relationships with them, and then it's going to lead to other frictions. It's going to lead to more issues. Be mindful. Be mindful there. Low profitability. These are extended, like strained relationships. Those are external issues that may create internal issues in the end. Low profitability, though, if we're not tracking our cash sufficiently well, it may be due to either low profitability and margins, or it may be due to things that we're just not observing, we're not really reacting to or being proactive about, right? The first two may lead to the third one. Ultimately, and we don't want to come here, business closure. So one little thing that we could have prevented by analyzing and really evaluating how to turn things around more quickly or more efficiently, and we didn't get to, and we didn't address the issue there, may ultimately lead us to business closure, which is the ultimate thing that we don't want to get to, right? Let's get to, if we can go back to maybe the missed opportunities and explore and reevaluate and see how we can make amends or do a better job of addressing the issue. None of this should happen. Common causes of cash flow problems. Here we go. Insufficient cash revenues, lack of cash reserves can make it difficult to weather short-term emergencies. That is probably the most common one, right? Uncontrolled growth. Pay attention. Pay attention. There's such thing as growing too quick, growing too big, too fast, right? This leads to cash flow mistakes. If we're growing too big, too quickly, we're not really analyzing how we're spending our cash resources. And we may throw resources into things or processes or opportunities, quote unquote, that may not be there because we're not planning well enough. We're not taking into account how this process will affect in the long run, right? High expenses, huge. Overspending on new equipment, marketing, and upgrading workspace. High expenses on anything. Spending on anything that we don't plan for. Spending money on anything that we don't have a strategy for is ultimately going to be a downfall. Anything that we spend, any process that we put in place, any marketing issues, let's make sure that we analyze the data and that it says, okay, if we're spending money here, then this is probably the most likely outcome. If we're spending money here, this is going to be the most likely outcome. By the way, go to the data, go to the numbers, see what the data is telling you, see what the historicals are telling you. It's very easy to fall in a pattern of like, yeah, this feels good, let's throw some resources. Or, yeah, I've got a gut feeling about this, let's go for it, right? Yes, sometimes that works, but those are the outliers. That's not necessarily the norm. Let's really, really be resourceful, strategic, and mindful about where we're spending our resources. They're not finite. They're not infinite. They're absolutely finite. And if we're not managing that cash flow well, it's going to give us issues all the time, every single time. As we can see here, poor cash flow management, leading costs of business failure. We see it all the time. Trust me, we see it all the time. Let us not fall into that cycle, right? Address the issues, address the little hiccups on a very, very strategic manner. Things to remember. We've got here, positive cash flow does not equal profitability. Absolutely true. It may, but not necessarily. Cash flow measures cash in and out. Positive cash flow indicates more income than expenses. Profitability reflects profit after costs and expenses. Here's the difference between the two. A positive cash flow in a business does not necessarily mean it's profitable. Cash flow refers to the net amount of cash and cash equivalents being transferred in and out of a business. A positive cash flow indicates that the company is generating more cash than it is spending, which is crucial for maintaining business operations. However, this does not always reflect the true profitability of the business. That's important to remember. Okay? Positive cash flow can come from loans or assets and sales, not just profits. That's the difference. We can have positive cash flow by injecting either a loan or capital infusion or owner's investment. And that doesn't mean that it's a profitable business, right? The profitable business is when the business itself, it's covering all of the expenses, variable and fixed, and doesn't necessitate any other capital infusion into the business. Make sense? Okay. Paper benefits do not always mean cash in hand. Selling on credit can delay real cash flow. Important to note, for all of us who are considering utilizing credit cards and things of that sort, it may delay the real cash flow. Positive cash flow and profitability both matter. Don't get me wrong. It's not one is better than the other. Both are really, really important to gauge the health of the business. Analyze cash flow and profitability when making decisions. Analyze both, right? Make sure that we're taking into account both concepts of cash flow and profitability when we're ultimately making that strategic decision and move. Okay, now let's look at a cash flow statement versus a profit and loss statement. Here's some of the main differences between the two statements. Similar enough, but one considers a few things and then that the other one doesn't, and then the other one considers a few things that the cash flow doesn't, or the profit and loss statement that the cash flow doesn't. Okay? Both, absolutely both track financial activities, but give different information. Both important. I'm not saying one is better than the other one. Both are really, really important. Examples here, owner contributions, cash in the cash flow. It's shown in the cash flow statement, but not in the income reflected on the profit and loss, right? Owner contributions are not going to be reflected here. We're going to see an example in the next few slides. Any new funds from a loan go in the cash flow, not going to be reflected on the profit and loss statement. Okay, depreciation, on the other hand, is not a transaction. But it's a taxable expense on a profit and loss. So this one is going to appear in the profit and loss, not in the cash flow, right? Okay. And then lastly, we've got owner's draw. This is cash out. It's reflected on the cash flow statement, but not a taxable expense on the profit and loss statement. Okay, so you're not going to see it reflected. Let's see a sample of what a cash flow statement may look like. It may differ slightly from what you're seeing on the screen, but this is kind of the essence of what a cash flow statement is. We're going to see loan payments, we got capital purchases, we got owner's draw there. So those things are going to be different on a cash flow statement. They'll appear here, and then they're not going to be present on the profit and loss statement. Here we go. This is what a typical profit and loss statement should look like. As you can see, also a big difference that I missed is the cost of the sales. This one has it just as sales. Over here, we have it kind of broken down into what the services were and how the cash came in. You see here that there's appreciation there towards the bottom of the table, right before total expenses. That does not appear on a cash flow statement. So these are similar statements, both with really good information, both really important to gauge the health of the business, and absolutely consider them both as we're moving on and creating strategic decisions. Okay? That's the comparison between the two, side by side. Fairly similar, but there's some differences that we should account for. All right, my friends, that's all I've got for you today. Thank you so much for your time. It's been an absolute pleasure. I'll see you in the next one.